Okay, thank you very much. Good to see you all in the room. It's a pleasure to be here to talk about global small and mid-cap equities, which is a part of the market that we're very excited about. So today we're going to talk to you why we believe that global small and mid-cap engine equities can be the next growth engine within your portfolios, why recent underperformance within this part of the market has created a really attractive valuation opportunity, and why we think high-quality mid-cap companies are best positioned for the next phase of growth. So we'll begin by defining what we mean when we're talking about global small and mid-caps, because it can be a little bit different to what people perceive. So the MSCI World Mid-Cap Index is the bottom 28% of global developed market countries. There's about 4,600 companies in this index. And currently, the vast majority of this universe is between $1 billion US and $50 billion US. So probably a little bit larger than what some people expect. If you think about that in the Australian context, I think there's only about 10 or just under 10 companies in Australia that are above $50 billion US. So in that context, some sizable companies, but still a very different universe to what you find at the large cap and mega cap part of the market. If you look at the MSCI World Large Cap Index, the average weighted market cap right now is over $1 trillion. So we think you do still get some diversification, some unique opportunities in this part of the market. And it's one that we really like. One of the benefits is that diversification. And we've heard earlier around the concentration risks in the market. And that's absolutely there. If you think about the Australian market, the top 10 stocks in the Australian market are nearly half the market right now. CBA alone is over 10% of the market. Similar story when you're looking at the global large cap index. So over 30% of the large cap index is in the top 10 stocks, and nearly 3/4 of that large cap index is in the US market. So a lot of concentration risk. By contrast, the global small mid caps, you've only got the top 10 stocks are less than 3% of the index, and there's a lot more diversification by sector, region. There is certainly diversification benefits. We know that concentration risk has helped a lot of investors in recent years when you think about the mega cap tech stocks and so forth, and even in the Australian market. But we think it makes sense to think about taking profits from some of those concentrated bets, diversifying. And as we'll see next, diversification doesn't have to mean sacrificing returns. So this is the global mid caps versus global large caps over the last 25 years. You can see here they've outperformed by about 1% per annum over 25 years. It doesn't sound like too much, but obviously with the power of compounding, that does translate into quite significant differences in returns over time. So the logical question is, well, what's driving this outperformance? And our view is it's really the underlying growth. So if you look, the bottom part of this slide is revenue growth and earnings growth of the small mid-cap part of the market relative to large caps. And over various time periods, and even on a forecast basis, mid-caps do outperform. There's various reasons for that. They've got a longer runway for growth, more white space opportunities, often more agile and innovative, and they can compound a lot more off a lower base. So there's a lot of reasons why we think this is an enduring and structural reason why mid-caps will continue to outperform. One of the other benefits you get is there's much greater market inefficiencies in this part of the market. So there's a lot less analyst coverage from the sell side, a lot less institutional ownership. The graphic on the bottom of this slide shows the average mid-cap company is only covered by 9 sell-side analysts, and you get a lot of the bigger bulge bracket brokers that are not covering this part of the market. Compare that to the Mag 7, and there's 72 analysts covering that from the sell side. There's nearly 2/3 of companies are covered by 10 analysts or less. So this less coverage, less institutional ownership often means that there's more mispricings that active investors can take advantage of. And so we really think it's a fertile hunting ground for alpha for active managers. Now, this is something that excites us at the moment. I mean, the valuation opportunity is fantastic at the moment. So I spoke earlier about how small mid caps have outperformed over the long term, and that is true. But what we've seen in the last 5 to 7 years is actually large and mega caps have actually outperformed. The reason for that is not because they've grown faster. Small mid caps have continued to grow faster, but it's really just a valuation dislocation. So on the right-hand side of this slide, it's the relative ratio of the large caps versus the mid caps. And you can see historically, mid caps typically traded at a 5 to 10% premium to large caps because of that growth the growth over and above the large caps. But right now, and what we've seen in the last few years, that's now moved to a 19% discount. So we think the valuation dislocation means that you're getting these great growth companies at a discount. If you compare the discount versus the MSCI World Large Cap Growth Index, it's 40% now. So some great companies growing and they're trading at a discount. Now, I've touched on the opportunity within SMID caps, obviously the structural growth advantages, the diversification benefits, the market inefficiencies, and we just talked about the valuation discount. But there are certain risks and challenges people need to consider when they're investing in this part of the market. And so this is why we believe that investing in quality companies can help mitigate some of these risks. So the business quality within SMID caps can vary. There's about 20% of the market is not actually making a profit. So it means that there can be more volatility. Obviously, balance sheets in certain parts of the market are not as strong. The dispersion in the quality of the management can be greater. So we believe that investing in quality in this part of the market makes sense and is a way that you can still capture the upside of the market, but mitigate some of the inherent risks of the asset class. And why is now a great time to invest in quality? So this chart shows the MSCI World Quality Index relative to the MSCI World Index over rolling 12-month periods. You can see over the long term, quality outperforms around 2.5% per annum. But what we've seen right now in the last sort of 12 months or so, where that question mark is on the bottom right, is quality has significantly underperformed. And basically the worst underperformance that we've seen in the past 20 years. It can be volatile over time. Obviously, you can see there is periods where it goes through this, but what we see each time quality has underperformed by 5% on a rolling 12-month basis, each of those 5 data points there, it has always outperformed in the following 2 years, on average by about 3% per annum. So we think quality is poised to rebound, and there's a lot of reasons for that. So we think the timing of investing in quality right now is attractive as well. Now, this is just an example of some of the great quality SMID cap companies that you get in this part of the market. You may have heard or seen some of these companies before, but a lot of them are probably not household names that everyone would know. But they are very much their market leaders in their own niches. They're dominating their fields. They've still got a long runway for growth. So these are some of the great companies, but there's a lot of these companies in the universe that we think active managers can identify. So this is just a small taste of that. And it would be remiss of me not to touch on AI. It's obviously the biggest topic on the minds of a lot of people at the moment. You can see, obviously, the hyperscaler capex, I think, was showed earlier. The top 5 hyperscalers are going to be spending over $600 billion this year on AI or capex. And so everybody knows the obvious beneficiaries in the large cap land, NVIDIA's, TSMC's, some of these companies. But when you dig below the surface and look in the small mid-cap part of the market, there is a lot of great opportunities there as well. So I've just listed, these are just a bunch of names in this part of the market that are really benefiting from this AI capex spend. The interesting thing about all of these companies is that every single one of them outperformed NVIDIA in terms of their share price performance over the last 12 months. So there's some great opportunities there that are definitely off the radar of a lot of investors. While AI is getting a lot of the attention, what we also love finding is these boring compounders that you can buy and hold for the long term, and you buy them when they are these smaller mid caps and really just get the benefits of that compounding over the long term. So this is a company called Cencora, which is a US pharmaceutical distributor. We first purchased in our portfolios around 15 years ago. Quite a boring business, but one that steadily grows its earnings year after year. So it's grown its earnings at a 14% compounded rate over 15 years. That's translated into 18% per annum shareholder returns, which is over 1,000% shareholder returns over 15 years. So we think there's a lot of opportunities like this in the small mid-cap part of the market. You can identify early, hold them long term, and just benefit from the power of compounding. A question we often get asked is, well, what's the catalyst going to be? I mean, I showed you the valuation disconnect, but that has persisted for a few years now. So question is there a catalyst that's going to drive a rotation back into smaller mid caps? And we certainly don't have a crystal ball, but there are some, what we believe some highly plausible catalysts listed on this slide that could play out and drive that rotation. You don't need every single one of these to play out. Just there could be one or two that triggers the rotation. And encouragingly, what we've already seen this year to date, is smaller mid-caps start to outperform. So relative to large caps, they've outperformed by about 300 basis points year to date. So we're already starting to see that play out, and we still think there's a lot of room to run. So to summarize, we think that the global small mid-cap, and particularly the quality part of the market, is a compelling part for an investment opportunity at the moment. Obviously, the superior growth opportunity, the valuation opportunity, the diversification benefits, the market inefficiencies that active managers can take advantage of. And we think quality in itself has excellent rebound potential right now, given what it's been through in the last 12 to 18 months. So with that, I'll wrap it up there and pass it over to Tom.
Right, thank you. My presentation is a little bit different in style, but upfront, for those of you who don't know us, I run Nanook Asset Management. We have a global equity fund that's focused on investing in parts of the global economy that are aligned with structural changes towards greater efficiency and sustainability over time. Quite a broad remit focused on efficiency, electrification, automation, digitalisation, decarbonisation and sustainability. We've been running the fund for a bit over 10 years now. It's been outperforming, and I wouldn't be up here talking if I didn't think that that was going to continue. But what I'm going to talk about today is to the topic, where are the opportunities in global markets today? And the way I'd like to do that is to try and put together a few pieces of the jigsaw puzzle, and hopefully that is of interest and highlights to you the way that we're seeing global markets at the moment and where we're seeing opportunities and how we're trying to exploit them. The first piece of the puzzle is what's going on with global equities generally and the remarkable sort of sustained outperformance of passive strategies in recent years, which has been to a large degree driven by the performance of the largest cap stocks in the market. The chart here shows the performance, the weighting or proportion of global equities made up by the top 14 or 15 AI-related tech stocks, which now account for about 14 of the top 20 stocks by market cap, and they've gone from being about 6% of the market to now a quarter of the market. That's not surprising given the way that they've performed over that last 10-year time frame. Extremely impressive performance, and the logical sort of inference from that is they've gone up in price a lot and become expensive, and that's not necessarily sustainable. But if you look into what has happened, yes, there's been a valuation re-rating. PEs have gone up, but they've actually been relatively stable over the last 5 or 6 years, in fact, come down recently. And that increase a few years ago has coincided with an improvement in both the underlying quality, return on capital of those businesses and their growth, and is largely justified on that basis. And if you want to illustrate that simply, you only need to look at the valuation multiples that businesses like Microsoft and Nvidia trade on today, on forward PE multiples, in this case for Nvidia, lower than the broader market or the rest of the market outside these tech stocks. Despite the fact they're growing at twice the rate at returns on capital that are much higher. It's very easy to substantiate an argument that these businesses are still relatively cheap despite their performance. And that's sort of context for an argument that it isn't really that clear that large cap tech and passive strategies might continue to do quite well. Equities market observations. We've been in this phase for quite a period of time of pretty consistent outperformance of growth and quality strategies. That broke about 12 months ago in quite a dramatic fashion. So going back to 2022 up until about September last year, very sort of consistent underperformance from value and small cap, and growth outperforming over that time frame. Since then, you've seen a very sharp reversal of that, and you might infer that that sort of portends a long continuation of the recent trend. If you look into the way that different parts of the market, the different sort of segments related to whether they're quality or growth or value, small cap, and how they've been priced over the long run relative to each other, that picture's not so clear. You go back a couple of years ago and it was clear that quality stocks were getting very expensive in a relative basis, and unless the growth and quality of those quality stocks got even better, there was a very good chance that they'd underperform as they have. Same was true of growth, maybe to not the same extent. And value and smalls were arguably cheap. But given what's just happened, that's really not any longer the case. And what that means where we are today is that what happens going forward's much more likely to be dictated by the way that the fundamentals of those parts of the market improve. So if you're looking at quality and growth, that the stocks that make those up, which is in a large part these tech stocks, continue to do well. Value, it might be more things like financials. If you expect that the profitability of financials to improve significantly, value might stack up, but otherwise it's not as cheap as it was. You've also seen some pretty significant and notable divergences in sector performance. The one I'd highlight is the difference in recent performance between tech hardware and software. Software stocks have dramatically underperformed over the last 6 or so months. And you see that in other parts of the market, and we're starting to see performance in some of what we look at, things like renewable energy starting to perform strongly relative to the rest of the market. And I put up this chart, which is actually quite an interesting one, that shows the relative performance of renewable energy or clean tech stocks against the broader market over the last couple of US presidential terms. And I put it up there because it shows a phenomenon that is completely counterintuitive, that those types of stocks have done very well under Trump's administration and did very well under did very poorly under Biden's, which was the period during which policy support escalated very significantly. And you're seeing the reverse of that. I put that up there because it sort of highlights that that the returns aren't necessarily where you might think they are during periods of change at a macro level. Third topic was views on AI. I think this is probably the most informative chart of our views on this. It shows a Gartner hype cycle put out earlier this year, looking at where different AI technologies sit on what Gartner call their hype cycle curve. And apologies, you won't be able to read that from the back of the room necessarily, but right at the top of that peak of inflated expectations is agentic AI. And that's very consistent with, I guess, what we were hearing in the narrative generally towards the end of last year, that all of our jobs were going to get replaced by AI agents imminently, and the world was about to get flipped on its head. Whilst we are moving in that direction and a lot of labour will be replaced with agentic AI solutions over time, I think what we're seeing this year already is that the enterprise scale rollout of that in a secure and controlled way is actually extremely difficult, and it's going to take longer and not be done perhaps in the way that people were thinking talking about a couple of months ago, and that there are still significant roles for software businesses and things like consulting businesses in making that happen. The data or the AI sort of phenomenon that we're in at the moment, we think is absolutely an economic phenomenon, not a bubble, and that the data center capex cycle that we're in at the moment is extremely likely to continue in the medium term. That said, this continued investment in those large language models isn't necessarily necessary to make them useful. They're already profoundly good. Not just profoundly good, but there are several of them that are profoundly good, and they're interchangeable and becoming increasingly commoditized. And that raises some really big questions about the economic models of some of these large cap technology businesses. As I said, the challenges are becoming much more evident, and we're moving now also into a period in which what they call physical AI, use of generative AI in things like robotics and in cars for autonomous driving, are starting to become real very quickly. But there's still a lot of things we don't know about the way that this will play out, when people will stop investing in bigger models and spending money on bigger, more expensive data centers, whether profits will accrue to the people who are doing that, and how things will play out in terms of geopolitical influence. These are strategically important assets, particularly from a defence perspective, and how regulation will start to control how we're using them in consumer applications. The way that we interpret that is that the trend is continuing, the investment is continuing, but the companies that are likely to benefit from that in the medium term are becoming the secondary and tertiary beneficiaries of that trend. And that spreads across quite a wide range of different types of businesses and solutions, some of them showing up here, from energy infrastructure and companies dealing with the flow-on effects of data centers using a lot of the power, optical data networks for connecting data centers and transferring data through to the businesses, implementing and controlling the governance around these types of systems. The fourth piece of the puzzle, what's going on with the Middle East at the moment. And I don't know how that's going to resolve. I wouldn't profess to know how that's going to resolve. I'd question seriously anyone who thinks that they do know and can predict that. And we need to just deal with that situation as it's evolving. And it could, significantly impact asset classes negatively. It could also resolve in a way in which things reverse very quickly at some point. What I think is certain, and this plays very strongly to what we do, that this is a shock of the same nature as the oil crisis back in the 1970s and will prompt a very significant government response over the medium term to avoid the geopolitical risk that has now become, very evident and real with oil from the Middle East. And the beneficiaries of that will be alternative energy solutions, energy efficiency, fuel efficiency, and the investment that goes in around those things. And they're all areas of interest to us. Some of them we're invested in already. Interestingly, they've done reasonably well over the last couple of weeks and helped the performance of our fund over that time frame. And then finally, the last piece, and I think this is perhaps the most interesting and least well understood of these things. This chart, which once again, I apologise, you won't be able to read cleanly, shows the relative performance of a bunch of different industry groupings within global equities. The top two are the FANGs and AI-related technology stocks, which since ChatGPT was launched in late 2022 have done extremely well, not surprisingly, and for good reason. But there's a very broad range of other more traditional technologies that are very dramatically underperformed over the same time frame. And it's been very easy to write that off as the negative effects of AI, when in fact that's not really been the primary cause of what we're seeing. And because of that, these trends not necessarily likely to persist. And the reason that you see so many of these industries, if I can just go, not sure where I'm pointing this. The reason that most of these industries have underperformed in that way goes back to COVID and industry cycles that started during 2020 and 2021 during the period when global supply chains and industries were massively disrupted by what happened with COVID. And what happened led to changes in consumer spending and supply chains having to adapt to a new reality and in some cases deliver against very rapid rises in demand. And that meant huge amounts of investment, not only in certain consumer products and technology, but the whole supply chains around delivering those and things like logistics through to things like the cardboard boxes that we're all getting things delivered in. And that upcycle, that build-up of inventories to manage that disruption, the capital investment in those industries has led very naturally to a very large extended down cycle in a lot of industries. Analog semiconductors is a great example. The chart here shows the inventory levels of the major analog semiconductor players. There was a big drawdown when COVID started because they couldn't manufacture in the same way and demand was strong. They built up inventories to meet that demand. Demand slowed, and now they've been dealing with falling inventories. And that's not been good for growth or profitability. And at the same time, the industry put a lot of capex in to expand its capacity to meet that demand in the short term, ended up in overcapacity, and now capex has been cut back to levels that we haven't seen in that industry for a very long time. Now, that cycle is coming to an end. And as it comes to an end, you'll see a pickup in growth in a lot of companies, reversion of profitability, and great investment opportunities in those areas where share prices have underperformed significantly. And we think we're getting to the end of a period where there are a number of these industries that over the next 12 or 24 months will turn around in a way that provides growth opportunities for our fund. A few of them listed on the slide here, which I'm sure we can share with all of you later. That's it from me. Paul?
Good afternoon, all. And I won't sit on the mic. That might not be that comfortable. Thank you. Great presentations. Obviously, AI is the topic of the day, of the month, of the week, of the year, maybe of the decade. Something like 660 billion, I think your chart showed, is going to be spent on CapEx by the hyperscalers only. So plus everyone else along the value chain. Not every company participating in that, when you go more broadly, is likely to earn an economic return. We see that in past booms. So how do you distinguish between businesses where the end customer captures most of the benefit versus where the shareholder captures a substantial amount of the durable economics? Start with Joel, yeah.
Yeah, it's a good question. I mean, the good thing is that a lot of us as customers are going to benefit from this, and I'm sure we already are. As investors, yeah, I mean, the key point is there, the durability. So at the moment, it's very much a rising tide lifts all boats scenario where any company that has any, sort of exposure to the AI infrastructure build out is benefiting. And you've seen huge valuation expansions, huge earnings growth as well that's gone along with that. So for us, it's really identifying those companies that have durable competitive advantages. They're going to have the longer term pricing power. Just when some of this excessive spend sort of eases off, you want companies that are not going to get competed away. So there are areas like that. So dominant companies with strong market positions. You're not operating in commoditized markets because when the music stops or when CapEx slows a little bit, it doesn't even need to stop, so to speak. I mean, if you have hyperscalers come out later this year or next year or whenever the time may be and just indicate they're not going to be expanding the spend massively from here, then you will see those companies that aren't as strong potentially sell off first because, so there is risk building. The other thing is obviously the valuations. Now, I think Tom showed that, there are companies like NVIDIA where earnings have gone up so much that the valuations haven't expanded so much, but there are also a lot of companies where the valuations have expanded a lot. And so as an investor, to get paid, you don't want to just buy good companies. You want to buy companies that are trading at attractive prices. And so there is examples where we've owned stocks. One of the stocks we bought last year was a company called Teradyne, which does automated testing equipment for the semiconductor industry. We only owned the stock for 7 months because earnings were upgraded 50%. The stock went from 20 times earnings to 50 times earnings. So then what is built into those valuations in terms of future assumptions no longer leaves a very attractive risk reward. So we'll take profits in those sorts of names. So you've got to be very diligent about what you're buying in terms of longer term and also the valuations you're paying.
Tom, have you got anything to add in that respect?
I think that was a pretty comprehensive answer. I mean, I think at the end of the day, in these new technologies, it doesn't portend some new paradigm of how the world works and how the economy works. It will come down to the basic sort of rudimentary economic principles. And I mentioned before the commoditization of these large language models. That's going to make it very difficult for the companies making those models to monetize them effectively. And I think you're already seeing a lot of them trying to adapt their business models to that reality, knowing that for most of us, for most applications, we'll have low switching costs and a lot of options in terms of what we can use. And that doesn't bode well, but there are other parts of the value chain and secondary and tertiary beneficiaries where that's not the case.
You've both highlighted that a lot of the focus and a lot of the returning markets has been dominated by a very narrow group of predominantly US mega caps. Where are you seeing, and I think there was some touching on in the presentation, but what are the less obvious second and third order opportunities that you find most compelling, and how do you uncover those? Tom?
Look, the ideas come from all from a number of different ways of thinking about how to find returns in equity markets. One of those is sort of the qualitative thinking about how this technology is going to evolve and what's likely to happen with its usage and the problems and how they're going to be solved. And I listed a few of the areas that we're focused on, but one that interests me is the regulation and compliance around AI, because we're talking about this technology replacing people who are, in many industries trained and licensed and regulated and controlled. And wherever this technology is delivering advice directly or services involved in delivering services directly, perhaps in healthcare is a good example, it will inevitably be subject to some form of regulation and control. And there'll be a whole industry that doesn't exist today around how you assess and monitor on a continual basis these models which are learning and changing over time. And that's a business opportunity for a set of companies out there.
Terrific. Joel, I introduced earlier. Were you in the room when I asked the question? So Joel's the one who went to Japan, so you know. And just so we can, address that AI topic, did you get a souvenir?
No, I'm sorry, Toby, I didn't get a souvenir.
Okay, so the AI wasn't all over it. What opportunities did you see in terms of, from a growth perspective, out of that trip to Japan?
Yeah, I mean, Japan's a very interesting market at the moment. It's one that we've definitely been increasing our exposure in recent years. And, I was there a couple of weeks ago. I think there's numerous reasons why the investment set is improving there. One of those is just the macro environment. It's more favourable for companies producing better profits. There's a little bit of inflation. I think wage inflation is running at 5%. So consumers in certain parts of the market are becoming more confident. And then obviously the corporate governance reforms that we've seen in recent years are having a real impact. So companies, the return on equities of companies is very much improving. They're doing a lot more buybacks. They're restructuring their businesses. They're selling off businesses who are not profitable. And these sorts of things weren't happening 5, 10, 15 years ago. So there's very real reasons why a lot of these Japanese companies are improving their profitability and as such are becoming more attractive as investment opportunities. There's also some very interesting niches that are benefiting from the AI semiconductor supply chain. We've got a couple of investments there, Disco Corp, which does dicing and grinding semiconductor tools, Hoya, which is a bit of a diversified company but has a very strong business in EUV mask blanks. So there's some very unique niche investment opportunities, but overall the opportunity set in Japan has improved dramatically in recent years from our view.
Terrific. Is there any question from the floor? Happy to take questions. Just put your hand up and team will get a mic too. We don't have long because of time constraints. What are the areas of the market that are overhyped, overpriced? I know you've shown some PEs and so forth, but perhaps they're not as overpriced. Some of the stocks aren't as overpriced as some may think. But what are the areas where you just don't think the current valuations are justified, and places you think you should avoid at the moment, or the room should avoid it? Tom?
It's a very difficult dynamic market to be investing in at the moment. I think if you want to take a very strong view on that, you've got to have a view on a scenario over the next few months. And we're being very cautious about how we manage the current environment so that we're not taking bets we can't know the answer to. Certainly there are parts of US markets, some of the defensive stocks that have done extremely well recently without significant improvements in fundamentals where we're cautious, but you can understand why people might want to own some of those things at the moment. On a medium-term view, it's got more to do with where you see the economy going and profits accruing. And we've talked a little bit about areas where there's concerns. Part of the software, industry is certainly, very concerning from a risk perspective. But the way the market's evolving, that's a. I don't want to give an answer today that might be wrong in a week or two's time.
Joel, do you have views on what's best avoided at the moment, despite the popularity of some of these? No?
Yeah, I wouldn't say we're actively avoiding any areas. I mean, you do have to keep an open mind. I mean, this spend is real that's going into AI, so you've got to keep an open mind. I think coming back to the point I was making earlier, there is just pockets of valuations that are getting quite excessive. So it's more around the valuations and what's justified longer term. If you want to just rent these stocks for a short period of time, some of these things might do very well. But then if you're going to hold them longer term in a year or 2 years or whatever the time frame may be, they might give back a lot of the gains. So it's just being very diligent around finding those companies that really have that sustainable competitive advantage, and then just making sure you're not overpaying for that.